The global financial market has entered a phase of profound and deceptive tranquility recently. To the casual observer viewing the daily charts, the precious metal might seem to have lost its previous momentum and speculative appeal entirely. The asset is boring again right now, but that is exactly the underlying point. Trading volumes have dropped in recent weeks as prices fluctuate within a broad range between $4,600 and $4,900 an ounce. Despite ongoing geopolitical tensions and elevated economic anxiety, there is little sense of urgency driving near-term positioning among global investors in the current environment. This sense of market boredom is less a problem than a reflection of how the gold market is currently functioning today. Despite relatively restrained price movement across trading sessions, the precious metal continues to act as a crucial anchor within a global financial system, showing increasing signs of fundamental structural strain. The current consolidation phase reflects not a lack of interest from buyers, but rather a significant shift in how the metal is being used and who exactly is buying it. Investors are increasingly demanding assets that provide both safety and reliable liquidity during periods of extreme global economic and political uncertainty. Market commentary in recent months has increasingly focused on the widening gap between asset valuations and underlying risks. These concerns are particularly evident in equities and sovereign debt markets worldwide. In this environment, the metal is being treated as essential insurance against broader systemic stress, rather than a mere speculative vehicle. The first quarter of 2026 will be remembered in financial history as a period of unprecedented price discovery. The asset entered the year with explosive momentum, driven by an alignment of macroeconomic factors including mounting government debts and rising geopolitical tensions across the volatile Middle East region. This vertical ascent early in the year was driven by what analysts have termed the fear and wealth framework. The fear component was firmly rooted in the outbreak of military operations involving multiple nations, which threatened to shut down major shipping routes and trigger a massive global energy supply shock. The wealth component reflected the surging purchasing power of emerging market consumers. In nations like China and India, the precious metal remained the primary vehicle for wealth preservation amidst domestic economic instability. This immense physical demand provided a solid foundation for the initial price surge witnessed during the early months. However, the parabolic rise in January proved highly unsustainable in the short term. What followed was a record-setting volatility event during the first quarter. In the weeks following the peak, prices plummeted by over 26%, severely testing major support levels and shaking the confidence of speculative traders. The massive correction in March was not a signal of a structural breakdown in the fundamental bull market. It was rather a clear reflection of the metal acting as the most liquid emergency funding source for the world. Institutional investors sold holdings to meet margin calls and rebalance their portfolios. The dominant driver of market behavior recently has been the regional war in the Middle East. The conflict fundamentally altered the inflation and interest rate expectations of global markets. The threat of a total closure of major shipping straits pushed crude prices extremely high and stoked severe fears of stagflation. However, the price action in April has been defined by a sudden shift toward diplomacy. Just hours before a critical deadline, a temporary 2-week ceasefire was brokered between the United States and Iran. This agreement was a complex diplomatic instrument involving significant operational concessions regarding major waterway transit zones. The immediate market response to the ceasefire announcement was a paradox of safety. As the agreement was made public, oil prices crashed by 15%, while the precious metal actually jumped over 3%. This sudden jump reflected a deep realization that underlying inflationary pressures and geopolitical uncertainties remained unresolved. The ceasefire is viewed by institutional trading desks as incredibly fragile. Any breakdown in the negotiations currently taking place could instantly introduce the war premium back into the financial markets. This potential for sudden escalation prevents investors from aggressively shorting the metal despite the apparent calm on the surface today. The current boring stability of prices is simply the market finding a way to price in this fragile status quo. Investors are currently unwilling to bet against the asset given the massive geopolitical risks, but they are also hesitant to buy at elevated levels without a definitive catalyst driving momentum. Perhaps the most significant event for the long-term trajectory of prices occurred when the Department of Justice dropped its criminal investigation into the Federal Reserve chair. This move effectively paved the way for a major leadership transition that the broader market had been anticipating with considerable hope and trepidation. The incoming leadership has been unusually direct about the recent institutional failures of the central bank. Noting massive increases in the cost of living since the pandemic, the new direction signals a strong commitment to repairing currency credibility and successfully reanchoring inflation expectations across the entirety of the domestic economy. However, this new era faces a fundamental constraint caused by a massive national debt overhang. In a regime of fiscal dominance, the ability to maintain a truly restrictive stance is severely limited by the rising cost of servicing that debt. The government is paying billions every single month in interest. The current stance of monetary policymakers has effectively priced out any significant interest rate cuts for the first half of the year. This reality is the primary reason the precious metal has struggled to reclaim its previous record highs despite the ongoing war and geopolitical tensions in the Middle East. As a non-yielding asset, the metal faces a high opportunity cost when real yields remain elevated. The relationship between real rates and pricing has become the dominant mechanism in the market today. Rising yields historically correlate with a notable decline in valuation, forcing investors to carefully reconsider their positions. The strategic reanchoring of the asset is a direct consequence of the unsustainable fiscal trajectory of major economies. With total federal debt approaching $40 trillion and massive deficits projected, the role of the metal has shifted significantly. It is now serving as a critical credit hedge against currency debasement. The mathematics of debt service have become the primary driver of institutional accumulation. When a nation pays more to service its past borrowing than it spends on its future defense or education, the fundamental credibility of its currency is deeply compromised. This reality pushes capital toward neutral assets providing security. Institutional investors are increasingly viewing the metal as the ultimate neutral asset that carries no sovereign issuer risk whatsoever. This is particularly relevant as the debt-to-gross domestic product ratio in the United States exceeds 120%, and similar dynamics play out across other major developed economies. The emergence of fiscal dominance implies that the Federal Reserve may eventually be forced to choose between price stability and the solvency of the national treasury. This situation, often described as financial repression, typically involves keeping interest rates below the rate of inflation to melt away the debt burden gradually. In such a severe financial scenario, the precious metal serves as the only reliable hedge for preserving wealth. This long-term structural case is exactly why major global banks maintain price targets at incredibly elevated levels, despite the numerous short-term headwinds generated by stubbornly high nominal interest rates today. Central banks remain the most important structural support for the current market environment. The motivation for their continuous buying is very clear to observers. It revolves around de-dollarization strategies and the ultimate protection of national sovereignty in an increasingly multipolar world, where traditional reserve currencies face unprecedented trust issues globally. The behavior of these sovereign institutions has been marked by massive diversification. Purchases are not just coming from traditional buyers, but a widening group of emerging nations. Countries are adding massive physical tonnages to their reserves to hedge against regional security risks and potential financial sanctions from dominant Western powers. Conversely, some central banks have utilized their physical holdings for their ultimate functional purpose. These nations have sold reserves to defend local currencies and bridge budget gaps during periods of extreme macroeconomic pressure. This activity provides essential liquidity in existential crises when traditional credit channels are completely blocked by sanctions. A new and significant source of demand has also emerged from the digital asset space. Stablecoin issuers have become major buyers of the physical metal. Major players have accumulated massive reserves, effectively locking up a significant portion of annual mine output to provide tangible backing for their digital currency tokens. The boring stability of the spot price has forced a brutal and necessary revaluation of the entire mining sector. The market has seen a clear segmentation of companies into specific categories based on their ability to generate internal funds. Cash-flowing producers are being heavily rewarded by investors right now. The primary driver of this market segmentation is the rising real interest rate environment, which has dramatically increased the discount rates applied to mining project valuations. At the same time, the industry is grappling with severe cost-based inflation, affecting critical inputs like diesel, chemical reagents, and specialized mining labor. Producers that can successfully self-fund their growth strategies through healthy operating margins are currently thriving. Meanwhile, those projects that require massive external financing are seeing their valuations contract significantly. The double squeeze of high financing costs and energy-driven inflation has made project sanctioning incredibly difficult for most developers. Large infrastructure projects located in higher risk or high-cost jurisdictions are finding it nearly impossible to advance without securing a major strategic partner. High-grade underground producers are surviving because their narrow-vein mining methods are naturally less exposed to the exponentially rising costs of waste movement and fuel. While the primary precious metal provides a strategic anchor for portfolios, its volatile cousin has emerged as a high-beta expression of identical macroeconomic themes. Silver is heavily augmented by a powerful industrial narrative today. The boring phase has not fully extended to silver, which continues experiencing supply-led volatility. The industrial silver market remains in its sixth consecutive year of severe deficit. Roughly 60% of annual consumption is now tied directly to the electronics and green energy sectors. A massive new demand impulse is coming from the relentless global build-out of advanced data centers and artificial intelligence infrastructure. Asian imports of the industrial metal surged massively as manufacturers and investors scrambled to secure raw materials for these critical industries. The retail effect in Asia has also heavily impacted demand, where buyers are turning to alternative metals as a significantly cheaper option compared to the more expensive traditional asset. The combination of a massive industrial deficit and a renewed investment bid suggests that this secondary metal may remain highly volatile. It presents a potentially rewarding opportunity within the precious metals complex for the remainder of the year. Investors are closely monitoring these changing dynamics across the entire commodity sector. The current stability of the primary market has misled some observers into believing that the massive bull run is definitively over. Some major banks even slashed their price forecasts recently, citing the rapid rise in real yields and delayed central bank rate cuts as justification for their newly pessimistic outlook. However, this strategic reset fails to account for the underlying fundamental strength originating from Eastern markets. While Western investors have been net sellers through exchange-traded funds recently, rotating capital into high-yield credit, the retail and central bank demand from Asia has provided an unbreakable floor for the price. The current market represents a fascinating tale of two completely divergent sentiments. The speculative Western traders provide the volatile ceiling, while the strategic Eastern buyers provide the solid foundation. The fact that prices have successfully tested and held key technical support levels under intense selling pressure is incredibly significant today. This powerful resilience suggests that the easy gains of the early year are indeed finished, but the market is now building a massive base for the next structural move higher. This next ascent will likely be triggered by a confirmed economic recession or a final forced pivot by central bankers. The immediate future of the market depends heavily on several primary variables. The outcome of ongoing international diplomatic negotiations, the first official statements from the newly appointed central bank leadership, and the continued resilience of consumer spending in the face of persistent inflation will all dictate the precise near-term trajectory. If diplomatic negotiations result in a comprehensive peace agreement, the market could see a significant liquidation of the current war premium. This scenario could potentially force prices to test lower safety zones again. However, if talks break down and critical shipping routes are threatened, prices will likely mount a swift recovery. From a strict monetary perspective, the upcoming policy meeting will be the final significant communication from the outgoing era. The broader market is carefully looking for specific exit language that provides a smooth bridge to the new chairmanship. A hawkish exit will easily maintain the current price ceiling for now. Any subtle hint of deep concern over the long-term debt service mathematics would immediately provide the necessary fuel for a massive bullish breakout. The reanchoring of prices at current levels is absolutely not a sign of failure, but a clear demonstration of the asset performing its unique role successfully. In a global economy where the staggering multi-trillion-dollar debt overhang acts as a permanent constraint on rational policy, the asset is crucial. Where regional wars can dramatically disrupt international energy markets in a matter of mere hours, this precious metal is the only asset that provides true portfolio neutrality. The distinctly boring nature of the market today is entirely the point. It is the quiet sound of a functioning market that has correctly priced in the severe risks of the present moment. It is patiently waiting for the inevitable consequences of poor fiscal and geopolitical choices to fully unfold. For the professional investor class, the current tight trading range is absolutely not a time for complacency, but rather a time for strategic and methodical accumulation. As the massive monthly interest bill continues to arrive for governments, the strategic necessity of holding this neutral asset has truly never been more apparent. The global financial order continues its inevitable shift toward a multipolar reality. The asset is boring again simply because it has successfully transitioned from a panic-driven crisis hedge into a reliable strategic anchor. It has absorbed the record-setting volatility of the first quarter and all recent geopolitical shocks. It now stands completely ready to serve its ultimate historic purpose in the turbulent years to come. In an age defined by extreme fiscal uncertainty and constant diplomatic peril, the stubborn stability of this ancient monetary metal is perhaps the only true financial certainty that remains for global investors today. The historical resilience of the market is mathematically consistent with its past performance during severe liquidity crunches. During previous global financial crises, the asset initially sold off rapidly as panicked investors scrambled for cash to cover massive leveraged losses in other tumbling asset classes across the broader international financial system. In both historical instances, once the immediate liquidity crunch finally subsided, the metal delivered incredibly robust returns. Its unique status as the ultimate emergency funding source was completely vindicated by the market. The volatility shock experienced earlier this year has already largely dissipated, proving the enduring strength of the asset. This expected stabilization is exactly what has been observed in recent trading volumes. While trading volume was down significantly compared to the explosive beginning of the year, underlying liquidity remained remarkably deep and resilient throughout the spring. Average daily volumes still doubled previous yearly averages despite the outwardly boring appearance. This exceptionally deep liquidity is the hidden structural value of the precious metal. It allows the asset to function flawlessly as a strategic necessity when all other conventional financial markets fail. As we look toward the remainder of the year, this strategic reanchoring provides the solid foundation for future appreciation. The boring market environment is actually a definitive sign of a perfectly healthy and functioning reserve asset. It is doing exactly what it was meant to do by surviving the macroeconomic storm. For sophisticated global investors who truly understand its fundamental role, the current price represents a barometer of transition. The transition toward a much more fragmented and financially constrained world is undeniably underway today. The recent pullback from massive record highs was an entirely healthy technical development. It washed out the weak speculative hands and transferred ownership to strong institutional entities, building permanent allocations for the long-term future. We must consider the sheer volume of metal flowing from Western vaults into Eastern hands. Record monthly outflows from North American funds were perfectly matched by sustained inflows across Asian markets. This massive wealth transfer demonstrates how emerging economies view the current consolidation as a generational opportunity to accumulate bullion. When prices fell sharply, Chinese and Indian buyers accelerated their physical purchases dramatically to secure tons of the metal. This underlying bid from the physical market fundamentally changes the trading dynamics. It establishes a remarkably robust price floor that purely financial paper markets simply cannot easily break through or manipulate. As paper contracts were sold off by commodity trading advisors following negative momentum signals, physical buyers eagerly absorbed the excess supply. This divergence between paper selling and physical buying is a hallmark of a maturing bull market. It proves that the asset is quietly building strength for its next advance. Ultimately, investors must recognize that extreme price stability after a historic run is a profound display of power. The asset refuses to yield significant ground despite multiple macroeconomic headwinds. It stands resolute against high interest rates and strong currency headwinds, proving its unmatched value as the ultimate safe haven today.